Think about this. There are people who wake up early, stay late, never miss a day of work, and still can't seem to get ahead. Their paycheck arrives and disappears. Savings never grow, debt never shrinks. Does it sound familiar? Here's the hard truth. The problem isn't how hard they're working, it's how they're thinking. Certain money mindsets are so deeply wired into us that we don't even notice them. Yet they quietly drain every dollar we earn. In this video, we're breaking down 7 dangerous money beliefs that are keeping a lot of people broke, and each one might hit closer to home than you expect. The number one is the belief that I will start investing when I have more money. Many people tell themselves this: once my boss increases my salary, once I pay off this bill, once things settle down, I will start investing. And just like that, months and years pass by with no changes. But here's the truth. Most people aren't waiting for more money. They're waiting because they're scared of losing the little they already have. I have been there before. You think about what happens when the investment goes wrong. How will you recover? Your fallback plans. Before you know it, you have already given up while the opportunity was still right in front of you. But here's what they don't realize. Waiting is the most expensive decision you can make. Every year you delay, you're not just standing still. You're falling behind. While some are waiting for a large sum to start, smart people search for low-cost index funds and ETFs that allow them to begin with small, consistent amounts. Think about this. 2 people earn the same salary. One waits until he is able to save a large amount before investing. The other one starts putting $200 every month in a low-cost index fund. In 10 to 15 years, the second person has built real wealth. Not because they earned more, but because they started early and let time and compounding do the heavy lifting. That's the power of consistency and timing. The market rewards those who show up early, not those who show up ready, because time is the most powerful advantage an investor has. The second one is the belief that saving money is enough. While growing up, we were all taught the same thing. Save your money. It sounds good, right? Although saving is good, but here's what nobody told you. Saving alone won't make you rich. It might actually even make you even poorer. The reason is this: inflation is silently working against you every single day. For instance, that $10,000 sitting in your bank account today will buy significantly less in 10 years than it does right now. That means your money isn't just sitting still, it's shrinking. Although most people stick to saving because investing feels risky, the market goes up and down, and it can feel like gambling. But avoiding the market completely doesn't eliminate risk. It simply replaces one risk with another. Think about 2 friends, John and James. John decided to play it safe. For 15 years, he kept saving his money in the bank. Every month, he added more to his savings, believing that keeping his money safe was the smartest choice. James took a different path. Instead of only saving, he started investing. Some of his money went into low-cost index funds, and over time, he also invested in real estate. Years passed. John still had money in his account, but its growth was slow and inflation quietly reduced what it could buy. James, on the other hand, watched his money begin to grow on its own. His investments started earning returns, and those returns started earning even more returns. That's the power of compounding. The longer you stay invested, the faster your wealth can grow. After 15 years, the difference between them wasn't how much they earned. The difference was simple. John saved his money. James gave his money a chance to grow. In essence, saving protects money while investing grows it. The number 3 is the belief that I can't afford to lose money. This fear is completely understandable. Nobody wants to watch their hard-earned money disappear. So people play it safe. Keep cash at home, leave it in a low-interest account, avoid anything that feels uncertain. But here's the reality. By trying to avoid all risk, they miss every opportunity. Markets do drop, temporarily. But historically, they always recover, like the dot-com bubble, the 2008 financial crisis, and even the 2020 pandemic. And those who stayed invested came out ahead. The people who lost weren't those who invested. They were the ones who panicked and pulled out at the wrong moment. So the secret isn't avoiding risk. It's managing it smartly. Smart people spread their money across different assets so that one bad investment doesn't wipe them out. This strategy, called diversification, simply means not putting all your eggs in one basket. For example, think of people who kept their savings in cash for a decade just to be safe. During that same decade, the gold price has more than tripled. Many ETFs have surged by more than 700%. Some stock prices have rallied by more than 1,000%, and even houses bought a decade ago have tripled in value. That means their caution didn't protect them. It cost them. In essence, safe doesn't always mean secure. The number 4 is the belief that I will invest after I enjoy life first. The pay raise finally comes through, and instead of investing it, a newer phone, a bigger apartment, a nicer car, and your life expenses surge as income grows. This is lifestyle inflation, and it's one of the quietest wealth killers out there. The justification might sound reasonable. I work hard, I deserve this. And maybe you do. But the deeper truth is that many of these upgrades aren't really about enjoyment. They're about not feeling left behind. Social pressure quietly drives financial decisions most people never think about. But here's the brutal reality. People get 3, 4, 5 raises over a decade and somehow still have zero savings. Income grew, lifestyle just grew faster. So, what's the simple fix? Invest first, spend what's left. Before lifestyle takes your paycheck, redirect a portion into safe assets that can pay you while you are sleeping, while you're not working, when your salary is delayed, when unexpected bills appear, and even when the economy becomes uncertain. Always remember that future you isn't asking for much. Just a small percentage set aside before the spending begins. Enjoying life today shouldn't cost you your entire future. The 5th one is the belief that opportunities are already gone. Imagine this. You watch the market rise for years, convincing yourself you missed it with thoughts like, if only I had bought this stock earlier. If only I had invested before the boom. So you decide to wait for a crash, a dip, and a perfect entry point. Now, instead of the market dropping, it climbed while you kept waiting for months. This mindset is more common than you think. And it's extraordinarily expensive. And here's something most people forget. Markets have grown for over 100 years. Through wars, recessions, crashes, and pandemics, the long-term direction has always been up. But yet in every generation, people believed they had already missed the best time to invest. And in the end, almost every generation turned out to be wrong. Remember this. The best time to invest was yesterday. The second best time is today. So stop waiting for the perfect moment, because the right moment rarely appears. The 6th belief is that rich people just got lucky. Most people often think like this. They were born into it. They were in the right place at the right time. They had opportunities I never had. And yes, privilege does exist, but this mindset does something dangerous. It makes wealth feel completely outside your control. And when you believe success is purely luck, why bother trying? That belief quietly becomes the permission to do nothing. But the reality is this. Most wealth isn't built overnight through lucky breaks. It's built slowly, deliberately, and consistently, through habits most people simply never develop. Studies show that a significant portion of wealthy individuals didn't inherit their money. They built it through disciplined, unglamorous strategies repeated over the years. They invested in index funds when others were chasing quick profits. They bought houses and land when prices were still affordable and held them for the long term. They identified promising stocks early and stayed invested while the businesses grew. They invested in precious metals like gold when economic uncertainty made others panic, using it to preserve their wealth over time. And over time, these small, consistent decisions create a huge difference. Think about this. 2 friends, Paul and John, are working in the same office and earning identical salaries. Paul spends everything, assuming wealth isn't meant for them. John invests quietly every month. 20 years later, which of them is financially secure? Same income, different mindset, completely different outcomes. Luck didn't separate them. Strategy did. The seventh belief is the mindset that I still have time. If you have been following from the beginning, you will notice that of all 7 mindsets, this one might be the most destructive because it sounds completely reasonable. You're not saying no to investing. You're just saying not yet. But not yet has a way of becoming never. Here's what procrastination actually costs you, and this is where most people feel it the most. Every year you delay investing as a year compounding could have been working for you. Compound growth simply means earning returns on your returns. Your money grows, then that growth grows, and then that growth grows again. It may seem small at first, but over the years it continues to multiply. For example, someone who invests $200 a month starting at age 25 could end up with far more money than someone who invests $300 a month starting at age 45, even though they invested less overall. That's not magic. That's the power of time. Every year you delay doesn't just cost you 1 year of growth. It costs you all the compounding that year would have triggered for the next 20, 30, 40 years. The honest reflection is this. Nobody who started investing early ever wished they had waited longer. Time is your greatest financial asset, and how you spend it determines your future. So the real question is this. Are you using that time to build wealth or letting it slip away? From the discussion so far, you will observe that the pattern is clear. A poor mindset circles around fear, waiting, consumption, and the need for certainty. It's always looking for the perfect moment that never arrives. But a wealth mindset operates differently. It circles around patience, consistency, and long-term thinking. In the beginning, it starts small, stays disciplined, and lets time do the heavy lifting. Hear this. Most people don't stay poor because they lack money. They stay poor because they never change the way they think about money. Today is the day to think differently. Start small. Start scared if you have to. And if this message was helpful, share it with your friends and don't forget to like and subscribe. Thank you.